Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, national underwriter for Old Capital. And joining me today would typically be Michael Becker, but he is on another due diligence assignment, which is really a cruise ship in the Caribbean with the real estate guys. So he is one of the speakers on the Real Estate Guys cruise again this year. And so he is talking with Robert Kiyosaki and a bunch of people down in the Caribbean. So we wish Michael a whole lot of fun doing due diligence around the bar. So joining me today on this podcast is all the loan officers from Old Capital. And this is the quarterly Loan Officer Roundtable Meeting for the beginning of the second quarter. This is our internal meeting that you get to listen to, and we will discuss multifamily investing, lending, how to buy right, finance appropriately, and stay ahead in the ever-changing multifamily world. So Old Capital is trying to do over $1 billion in real estate lending this year. And I think that we have the brightest and the smartest group of real estate lenders at this table. I enjoy this format because we're sitting around the table and we're talking lending. So we are here to educate you on what to be aware of in the commercial real estate lending. So joining us today is James Zhang.
Hey, Paul.
Ricardo Hinonosa.
Paul, how's it going?
Good. Les Meisel.
Hi, Paul.
Dave Walls.
Hi, Paul.
And I'd like to welcome John Brixon onto the Old Capital team. So, John, tell us a little bit about yourself and welcome aboard with Old Capital.
Sure. Thanks, Paul. I joined Old Capital in early February, and I'm based in Dallas. I work with James Zhang. I have 7 years of experience in commercial real estate financing. Prior to Old Capital, I was with A10 Capital in their Dallas office, focusing on financing properties for borrowers throughout the central U.S. And with Old Capital, I'm working with James and helping Old Capital grow to the $1 billion in originations, as you had mentioned.
Fantastic, so, John. Thanks for being on the team. So perhaps we'll have a few different topics to talk about. And so some of the things I'd like to kind of visit on is just kind of an update and the outlook on small balance lending. So guys, think about that. And the next downturn may be on the horizon, and how should clients be preparing for it? And number 3, an overview of commercial real estate markets and probably construction lending. So like always, we try to kick it off. And so James, how's it going out there and what should we be aware of?
Sure. Thanks, Paul. This past week, we released an article about how to win a multifamily deal here in DFW. And just this past quarter, there's probably over 40 transactions sort of in the BNC space that were listed. So a lot of those deals are coming to best and final now, and we're finding out who the winners are. And so I wanted to share sort of the 7 things that I'm seeing separate those sort of winners in deals from all the second place bidders. And so just the high level on the 7 things, and then we'll dive into each one of them. Number 1's pricing. Number 2 is hard money. Number 3 is days to close. Number 4 is debt term sheets. Number 5 is sources of equity. Number 6, multifamily transaction record. And number 7 is upfront due diligence. So let's just start off with number 1, and anyone can jump in here. I'll share my thoughts and then we'll get some comments from the group.
Fantastic.
Number 1, pricing. So most deals don't have a price. And so a lot of people are not used to that. There's typically just a whisper price from the listing broker. And depending on the broker, some brokers like to start really low and draw in a lot of people, and then have best and final with 15 people, and then a best and final of the best and final, and then a one more, how much more can you stretch final? And so it might go, 2 or 3 weeks of best and finals on deals. And other brokers, though, will have a really high whisper price, and they'll start out, $1 million or $2 million more than the seller wants, and they get no traction on the deal, and people feel bad even putting in an offer below the whisper price. So really get to know the listing brokers in your market here in DFW, every listing broker has a different strategy. And some sellers have, a preference for which way they're going to work the deal. And so at the end, though, unfortunately, pricing is typically down to most of these deals. Let's say on the $10 to $20 million deals, it might be only $25,000 or $50,000 in price differential between number one and number two. So I like to tell a lot of people, don't lose a deal over $25,000.
So a lot of people that we do business with obviously know us, and I'll give you a good example. I think it happened last week with one of the sellers on a property that they had 30 offers on it, and then they brought it down to 15 offers, and then it became down to, say, 3 offers. And then they wanted us to take a look at the deal and making sure that they were making the right choice and what seller or what buyer to pick. And so they had an original offer of X, and that was bidded up to a high Y. And the offer that had won the deal was a real high Y. And so the seller wanted really us to get involved to make sure that was a realistic number, that not everybody was just in an exuberation to try to win the deal, that they went the highest number possible. But he also wanted to make sure, at least we wanted to make sure too, that the buyer had worked out the numbers to attract the capital. Because most of these transactions get done in syndications. So what does it take to win a deal is one thing, but also too, what does it take to get your investors to put their money into a deal too? And so the seller wanted us to kind of figure out, was there enough juice, was there enough yield in the transactions that the limited partners, the equity people, were going to be able to put their money into the deal so they wouldn't get a false start. So that's one of our value-added pieces in the deal too, is having sellers kind of pick the right horse.
Any other comments on pricing from you guys?
James, just with what you're talking about, have you seen much evidence of experienced buyers coming in higher than knowing they're going to probably retrade back out?
So on the experience, what happens is the brokerage community is very tight-knit in DFW. And so if you are known as a retrader, then your deal even though you might have the highest offer, a lot of brokers are not even they might present it, but then the reputation behind it is that you're going to retrade the deal. So they would rather go someone who's going to actually close on the number that they're presenting. And so
you may think it's a good idea to try to get into the deal and win it, and then you think you should be able to retrade these deals. And James is absolutely correct, is once your reputation goes out there, even on a first deal, that you're retrading it. Now, unless there's significant physical damage or problem that you didn't realize when you made your offer, that's one thing. But just to retrade, just to get into the game, you will get a bad reputation, and then you probably will not be asked to the prom next year.
And so that leads into number 2, which is hard money. Yeah. So a lot of people coming to DFW for the first time are maybe shocked at the amount of hard money that's needed day one. So non-refundable earnest money can be anywhere from 1% to 2% day one. And then after due diligence, it might be another 1% to 2%. And so on these transactions that are of size, you could be $300,000, $400,000, $500,000 into the deal. And so it makes it very difficult to retrade. The seller knows that you're going to close. You're not walking away from $400,000, $500,000, especially it's your own money. So the general partner, the syndicator putting the deal together, is putting up this earnest money, and it might be sitting at the title company. It might be released to the seller already. And so the money is gone. So you guys, if you walk away from the deal, anything that you find in due diligence typically is not going to make you walk away from that much money on a deal of size.
Ricardo?
No, absolutely. I mean, that's extremely common. One of the things that I've seen buyers try to do to try to mitigate some of that risk, right? So if you're going hard $200,000-$300,000 day one, there's always an attempt to maybe try to get an access agreement, whether it's, leading up to the deal in contract negotiations or as the deal gets kicked off, but it's a very short time frame. What I've seen people be successful with is, hey, maybe a one-day exterior access where you get a roofer up there, you get a plumber to scope the sewer lines, you get all the big items checked off. So then, hey, there's nothing else in this deal that's going to cause me to have an issue. And then you go hard with, whatever the market demands on that deal. But very common.
And then, so a couple examples here. So we had a 160 unit deal. It needed a Class C deal, needed about 100,000. A 120 unit deal, Class C, needed 200,000. And then a B deal, 200 units, needed 500,000. So that was all day one, non-refundable earnest money. And then we just had a little 20 unit and they wanted 100,000. So you never know in these deals. So speak with the listing brokers, speak with us, and sort of figure out what's going to make you competitive on the hard money.
John?
Yeah, question for Ricardo. So at what point does a buyer get an access agreement? Is that once the offer is accepted and then before the contract signed, or when does that happen?
Typically, it's laid out in the LOI that, hey, I'm going to go hard with this money pending an access agreement, whether it be a day or two or whatever you're asking for. But it's either, I see it sometimes where the seller grants it during contract negotiations. Say, hey, go ahead and take your exterior access while we're working through the contract. But once it's executed, you're hard. Or I've also seen it where you get a day or two post-contract execution. So it's the first day or two of due diligence, really.
And I've seen a couple sellers actually want you to do that up front just because they don't want you to spend the money on legal and then not be able to do the deal so quickly. So,
Yeah, these contracts could take, say, a week or 2 weeks to be ironed out. It's going to go back and forth. These are red line contracts, so there's not final contracts. They go back to the buyer's counsel, back to the seller's counsel. So during that period of time, the clock is ticking on the attorneys. They're spending big bucks on behalf of the buyer and also the seller. You can get onto the property and see if there's any problems in the future of this deal. Another thing also too is on that, you put in your LOI, you have carve-outs. So even though you're going hard with $100,000 or $200,000 or $300,000, there's some environmental carve-outs, or there is some title issue carve-outs, which means that even though I'm going to give you $200,000, but if we find something in the first, say, 30 days from the title work that there's an easement or the property was built on the wrong side of the tracks and it was never approved by the city, that you can get your money back. So make sure you put those carve-outs in there too.
all right. And then number 3 here is days to close. And so majority of the deals that we're seeing, it's about 60 days. And most people are okay with that. Sellers are okay with that. I have seen a couple deals with shorter closings where somebody might be closing all cash. And that has gotten a little bit of a lower price, but most sellers are willing to wait the 60 days in order to get the highest price, as most Fannie and Freddie loans take about 45 to 60 days.
One of the things also too is that to collapse the timing on these transactions, if you want to pay a little bit extra to the property condition assessment report or pay it to the appraiser, they can take that instead of taking 21 days to get the reports, maybe they can do it in 10 days or 11 days. So, money cures a lot of timing issues. So if you do need to close this deal at a quicker time frame, you can pay to get these reports done a little quicker.
Right. All right. So number 4, debt term sheet. So this is what we provide you. We help you put together the financing. So as we like to say, we bring, 75, 80% of the money. Now it's probably 70 to 75% of the money, and you bring the rest of the money in equity. So get with us in terms of your term sheet to make sure that, whether the deal qualifies for Fannie Mae or Freddie Mac, the seller, the listing broker is going to want to see that you've been sort of pre-qualified by us in terms of experience to make sure you can buy the deal and qualify for the debt.
Absolutely correct. In some areas, maximum leverage on these properties is maybe 65% because the properties are just too damn expensive versus the cash flow on the property. And historically, for the last, say, 10 years or so, we were able to get 80%, but the values have gone up so much. The cap rates have compressed. The NOI is pretty much staying the same to a certain extent. And so we're burdened on our side to have a lower loan amount. And so we've gone from 80% maybe down to 75, or even some cases 70%. So you may need to raise more equity from your syndication on these deals. So just be prepared for that.
And so the next thing is equity. So number 5 is your source of equity. So a lot of people, especially if it's a $15, $20 million deal, typically don't have the equity to close on the deal by themselves. And so they're going to have to syndicate the equity. And so understanding the source of that equity and how many investors have invested with you as a general partner previously, where you're going to go get your equity is a huge concern for the listing broker and seller. And so we've had deals taken down by guys with, 1031 exchange money sitting there, and they're able to show the bank statement account for the potential buyer. And that is a very strong, after talking with us about the debt and then showing a 1031 statement or 1031 account with all the funds, that's pretty much a done deal. And so the seller gets a lot of comfort out of that. And so if you can't show all the equity raised, what I like to see is the key principals or managers showing bank statements that show that if their equity raise is a little short or the debt comes up a little short, they could fill that gap.
Right. Ricardo, what do you think about that?
I think it's spot on, especially the piece on the KPs. If they don't have the balance sheet to potentially chime in and help if there's a hiccup, the selling broker and the seller is going to get worried. So it's the strength of the KPs and then track record. So how many times have you done this in the past? Have you ever had any issues? Have you worked with a selling broker in the past? Are they comfortable with you? Can they vouch for you? All of that is a major impact.
Yeah, so, not only debt and equity. So number 6 is really the transaction record. And so we've seen deals where, the listing broker was more comfortable with the buyer because the buyer owned something in that submarket, or they had transacted with that listing broker. Or what some people forget is the buyer, the potential buyer, has a deal that they're going to list in the next quarter. And so having something to trade with some of these listing brokers is an incentive that they can see coming up in the next quarter that they need to fill their pipeline. And so think about what you have to offer, not only in terms of pricing and terms, but think about some of the intangible things that you can bring to the table.
I think that is so true on that. You cannot ask for something unless you give something sometimes. And then you have to be able to give them not only the opportunity if they sell you this deal, that down the road, maybe a year or 2 or 3, whenever you want to sell the transaction that you just bought, that you'll always remember where you got it from. And that broker who sold that deal to you is expecting, and we agree with it, is expecting for you to use them to sell that property back. So that's one thing to trade. But if you have other properties in your portfolio that are coming due, whether it's a maturity or you just executed your business plan, that's a chip at the table that you can use for leverage to buy your next deal that this person may be offering to you. What do you think about that?
The one piece I would add is if for some reason you don't have that experience, so let's say it's a smaller deal. For example, we're about to kick off a deal. It's about a $5 million deal. The sponsor did not have a ton of experience, didn't have any experience. So our guidance was you need to go out and get it. So that's where building the team is critical. So he was able to partner up with someone that does have experience with this selling broker, and the selling broker knew very well. So that helped mitigate that risk, helped them win the deal, and we're moving forward. So
Good.
There are ways around that.
No, that's perfect. The last thing here is upfront due diligence. So we talked about this on the access agreement, but then also when you go and tour these deals, who are you bringing with you? So who on your team is out there touring the deal, looking at the model, looking at a couple of vacant units and understanding the CapEx needs around this property and who's going to manage it for you. So a lot of these deals, let's say in Paul's example where it started with 30, dropped to 15, and now you have 3 or 4 in the best and final. The seller might get all 3 buyers on the phone and ask them questions around their CapEx plan. What's their, year 1 budget? How did they underwrite the deal to really get an understanding of how much research and how much are they invested in this deal? And so showing that you've done all the upfront work, it just shows that, once you get under contract, you're not going to go back and retrade the deal. There's not going to be any surprises. You've already done your homework. And that shows that you're just more prepared and that you're going to be able to close the deal.
Certainly true that the seller is trying to get the buyer as pregnant as possible with money and just confidence that they can get this deal done in the time frame that the seller can deal with, because maybe the seller is dealing with an exchange and it may have to take it out for 60 days or 90 days. Well, sometimes that works with no problem, that the seller is able to find another property. But then also too, is you want to talk about, we want to try to get this loan locked, and these locks are only good for 15, 21 days, or you want to go farther out to lock the rate. There's going to be some additional costs. So that initial upfront conference that you may have on the larger properties, you may not get it for $1 million or $2 million properties. The seller asking all these, what people would think infinite questions. It is just they're trying to find out the level of certainty of this deal if they pick you to get this deal closed.
Yeah, and I mean, to me, as when I'm sitting there listening to these calls, it's also like, if I'm the seller, can this guy represent not only to the lender that this is a good plan and this is the business plan, but also to the equity? So if the guy can't get on the phone and articulate it in 5 to 10 minutes the business plan, then the chance of him going out and raising $5-10 million in equity is pretty low.
Yeah, and we always try to be on those calls when it's the seller asking the questions of the buyer. And you always want to have your lender on the call, because whether they work for a large national bank or they work with Old Capital, we can kind of explain the structure of the deal. This is what we do every day. We speak with clarity, and sometimes the borrowers may get tongue-tied into the transaction in talking with the seller. But since we do this number of times a week, we kind of know what the buyers should be explaining and what the sellers want to hear.
Yeah, so I mean, especially on articulating the debt and how they're going to qualify for the debt and getting them comfortable with that is, in this market, it seems like the debt has gotten a little bit harder to get in terms of leverage. And so listing brokers are getting us on the phone a lot more. And the equity piece is typically easier at this point.
Yeah. So again, if you want to have the expertise of James Eng on your team, make sure you call Old Capital as your first choice on doing these type of transactions. Is there anything more, James?
I think that's it.
Okay,
Thanks,
Dave,
Paul.
I'm going to kick it over to you a little bit, and let's kind of talk about exceptions. When people buy apartment buildings, they may hit the ball, if this is a golf analogy, into the out of bounds markers. Not every transaction is right down the fairway, and sometimes you have to have exceptions by the lender. And so I wanted to kind of cover certain levels of exceptions and the risks that are involved. So let's kind of talk a little bit about, if your ball goes out of bounds, how can you mitigate that risk? So talk to me a little bit about what's going on.
Well, Paul, Fannie and Freddie, they have dozens of different items that they would consider a credit risk to a property. And, we don't have time to go through all of them. So I'm going to cherry pick a couple of these items out. And what's driven these choices for me is kind of what was being chatted about before with James, is the pricing of properties in the main markets now has made a lot of buyers look for better deals out in tertiary markets. So in other words, they're going out and hunting down properties in smaller markets because they may be getting better returns, and they just look better. They're not paying so much for the properties, and the cap rates are higher. So with the tertiary market, there comes issues sometimes with the lenders, because when you're buying a property in a tertiary market, for example, there may not be any good financials from the sellers. So quite often, we'll get a property. It's a great property. It's got a lot of potential. Could easily be an agency or a Freddie or a Fannie Mae loan, but there just isn't the documentation there. So what Freddie Mac or Fannie Mae will require is, they can't size a property up without any documentation or financials. So we can help the borrower put together a decent looking package that we can present to the agencies to get the loan qualified. And that actually, sometimes we have to ask for an exception where we just don't have any more than sometimes a year of P&Ls, because they just aren't there. And what we do have, we've had to cobble together and try and make a decent package so that we can at least have something we can give to the agencies to size a loan. And you do find that in the tertiary markets, that is a common problem. It's more of a mum and pop operation, particularly on the smaller properties. And so that's kind of a thing that we've got to do. The other thing, once again, with properties that are in a tertiary market is management. A lot of people are looking for buying a property, and typically if you live more than 100 miles away from that property, the agencies, even if you do have some experience, they're going to probably want someone closer to that property with local experience. So that's another thing, and sometimes we can mitigate that by encouraging our buyers to put together a great acquisition and management plan. We can kind of get that across the goal line by saying, yeah, we're not fitting all those boxes, but I think that our buyer with his acquisition plan, I think we can cross some of those hurdles.
So are we seeing lower LTVs in these tertiary markets, or how do Fannie and Freddie sort of mitigate the risk of it not being in a major metro like DFW?
Well, lower LTVs is typically one thing that they'll impose on the property. If in a large market it's 80% loan to value, in some of these smaller markets, depending on how small the market is, they may only go out to 75 or even 70%. And the other thing that they'll do is the debt service coverage will be increased. Typically, on most deals in major markets, like Dallas, Austin, Boston, San Francisco, you're going to get away with a 125 debt service coverage. But in these smaller tertiary markets, your debt service coverage, they might say, we want to see a 140 debt service coverage. And sometimes it's not that easy to get and to show, so you've got to do a little bit more homework, a bit more convincing, and possibly get an exception. You might not quite, you might be at 135, but you can get it across the goal line with a decent package and talking to Fannie and Freddie. So those are some of the things that come along with a tertiary market. Anyone else got any comments on that?
Dave, what about pricing? Is there an impact on pricing in those smaller markets?
When you say pricing, the
interest rates?
Yes, there is usually, depending on where it is, there is usually a hit on the interest rate because it's a tertiary market. Because historically, tertiary markets have more risk. They might be in a smaller town, a smaller population, so that right now the times are good. We've got full employment, and even in a small town, the deal looks pretty good. It'll work, but when things get a little bit harder, the tertiary market will suffer quicker than a big city. And so therefore, to mitigate that risk, the lender will drop back on the LTV. They will increase the
DSCR.
And the pricing too. Because with Fannie and Freddie, these loans are sold as mortgage-backed securities, and people who are bidding on those see a little bit more risk in a smaller tertiary market. So therefore, to kind of mitigate that risk, there's going to be a little bit of a higher interest rate.
And Dallas just got upgraded a little bit here in Freddie Mac's eyes. So on the Freddie Mac small balance side, we used to be, I guess, probably a standard market, and now we got moved up to top. So what that did was for only Dallas County. So if you're in one of the other metros, unfortunately, it doesn't work for you. But Dallas County, they dropped the DS debt service coverage to 120. And then they're able to get better pricing. And so if you had a deal that maybe was quoted a couple weeks ago or a couple months ago, then take a look at the Freddie small balance for Dallas County as well.
Right. Another exception, this is fairly common, more common than you would think, is the credit history or the credit of the borrower. Typically, for example, with Freddie Mac, they want to see a minimum of a 650 FICO score for the borrower. And, I've had several deals just recently where, it was quite a bit below that. However, we got it done because if you've got some other KPs that are in the deal that are a little bit stronger, you can mitigate that one signer, even if his credit score is a little bit lower. The fact that the other guys in the partnership have got a higher credit score, that can help that. And also, you've got to look at what causes credit to be low. And sometimes if they explore the credit report and take a look at exactly what happened, it may not be as bad as was initially thought. And so that can kind of help mitigate that. And we help there. We will talk to the underwriters and we'll sort of help back up and get it across the goal line if that was an issue.
So one of the things I've started doing is, especially as general partners, put together deals and start looking at who's going to sign with them as a KP or key principal on these deals. I'll usually send them 5 or 6 questions that we have to have answered in the loan application early on in the process. And so things like bankruptcy, prior bankruptcies, any type of litigation, and then credit score and citizenship, understanding that early in the process before these guys get too married to each other on a deal, and understanding if we need any waivers or exceptions to a report or for a deal, that we know that up front.
Absolutely, James. That's absolutely correct. If you've got problems, we don't want any surprises. So especially in a tertiary market where you're going to have challenges with financials, you're going to have challenges with a lot of different things. If you've got challenges as a borrower, let's know up front. don't surprise us down the line. So that's a great piece of advice there. Okay.
We kick it over to Ricardo and Les to jump into our next topic.
Yeah, definitely. One thing, an issue that we run into on occasion, and given the pricing, how tight things have been as we've talked, here recently I've had a couple of large deals, $10, $15 million deals where we underwrite the deal going in. We've had a nice upward trajectory in the income. It underwrites, well, okay, right? So let's say going in, we're getting 70, 75% leverage. So we're definitely debt service constrained on the deal. We get into escrow, and all of a sudden we start seeing a turn on the income, on performance of the property. We've underwritten this deal on probably T1 income, and we have expectations that when we underwrite that way, we're assuming that performance is going to continue to at least be flat. And if it's not, then we've got to go through and re-underwrite the deal. Obviously, that impacts the debt service coverage, and it impacts the loan. It could be pretty sizable. As we talked earlier, we have a lot of borrowers going hard day one with hundreds of thousands of dollars. And if your loan's getting cut $1 million right in the middle of the deal, obviously that can be a huge impact. So I wanted to just talk a little bit about ways to mitigate some of that risk up front. Any thoughts from the group on kind of what we've done in the past?
It's a tough one because we've seen buyers try to put in clauses in contracts saying, okay, well, your net rental collection right now is $90,000 a month. And for the next 3 months, I need you to maintain that number or greater. And the seller says, well, I'm not blowing up this deal because it comes in at $89,000. Like you should not be underwriting the deal that tight. And so to be conservative, you can always take a T3 on the number instead of taking that T1 because there can be an outlier. And sometimes, bad debt always seems to happen after you get under contract. And all of a sudden you filled up the place, but then nobody's paying. And so Fannie and Freddie are looking at the net rental collection. So what are you actually collecting and the economic occupancy of the property? And so the contract is one thing that you can ask for. We've seen sellers incentivize their staff to push on leasing and stay involved and give them a bonus until this deal closes. And we've seen sellers, not even have a leasing agent there for the last 2 months of the deal. So some sellers are better than others. And if you know what you're getting into, especially with a seller, then you as a buyer can only do so much with the occupancy of a property that you don't own yet. But preparing yourself, not only underwriting a little bit more conservatively, but then also being able to raise that equity or shorten up that gap if the debt comes in a little short.
I think comfort with a seller is critical. If you do know the seller and they have a solid property management company in place that has a long history of delivering, that's one thing. If you don't, if you're dealing with a mom and pop seller who doesn't have a lot of experience, there's some cause for concern there, right? You want to be careful. Don't get too risky in a situation like that. Just kind of understand what the risks are. That if the income drops, you've got to be okay with coming up with additional equity to be able to get the deal done. So just understand those risks going in, I think is key.
And now we'll kick it over to Les. Do you want to talk about, so as multifamily becomes harder and harder to get under contract in DFW, some people are thinking some different options. So talk about a recent deal that you're working on now.
Exactly. Everything going on the table, it's a tight market, and some of the rules have changed recently. So I think a lot of our clients are sort of looking at it through different colored glasses about how to proceed. And I've had a couple clients that as they're looking at seeing land that's available, and instead of trying to fight for existing properties, finding land that's available and looking at construction from the ground up. And while a normal construction loan, they're out there and they've been out there, some of my clients are looking at the FHA lending process. And the FHA lending process, it's LTV, LTCs can be 85% and maybe even higher. They have terms of 40 years, and it's sort of one-stop shopping from construction to long-term debt, which sounds wonderful, and it is great. But it does have some downside to it, or at least maybe not downside, but something to be very aware of. It's a long process. It has steps like initial concept meetings. It has steps of being invited to put in an application. And those can take 2 or 3 chances to look at that. Then there's a longer review process. So I think if you're setting expectations, the period of time in this can be 8 to 10 months. The other factor that we're aware of when we're buying properties, but more in construction with HUD, is they're extremely aware of densities in the area where you're building. Now, we're all aware of the market density in buying an apartment, multifamily, and what's around it. But HUD requires some fairly extensive market surveys, and they look kind of briefly at pent-up demand, but they really want to know what's in that area. So, and it's not just a matter of density of buildings that are being built or there. It's how many buildings they're involved with. They don't want to be saturated in any one market. So while you may not think that there is a high level of density in the market, there can be a high level of density in what HUD has in the market and has under contract or ready to finance. So just something to be very aware of. I have a recent client that we went through the steps and just sort of backed up and said, this is great, but with the density issue, with the amount of time that it's going to take to get this done, I think we'll just sort of tap the brakes and look at conventional construction. So it's a great program, but as any of the discussions we've had, you have to really do some great deal of internal due diligence of where you are in buying the property, what you have promised as far as raising equity, because it's going to take some time.
So talk about what the difference between, so you said 85%. So the FHA is going to be non-recourse, 85% loan to cost, 40-year term, approximate rate on that, and then compare that to conventional.
Well, I think most of the conventional construction we're seeing is probably 65%, 65 to 70 maybe, depending on the area. So that's a big difference as far as what you have to raise for equity. Rates are probably very similar.
So on something like that, when you are looking for an FHA loan, you have a couple different things that you have to consider. One is an MIP piece to the deal, and one is the rate itself. So the rate is going to probably be maybe about 0.75% less, and then you have to add the MIP to it too, which is going to probably be about 0.6 or so into the deal. So rates are going to be lower with FHA than you are going to be with a conventional piece. But the point I think that Les is trying to express is the timing that it's going to take. Now, if you do a regular conventional bank loan, you may get 65 or 70% leverage in the deal, so you have to raise a lot more capital. It's going to be a recourse loan, so it's not going to be a non-recourse loan. But you can probably get the deal done, let's say, in this cycle. So if you have to put something on the ground and you have investors or you bought the land on the deal, you want to start construction sooner than later, conventional is probably the way to get it done. So then you can always refinance and put into a Fannie Mae or even an FHA loan down the road. But FHA is a good piece. If you had the capacity to wait and present the deal, make sure you start your conversations, if you're thinking about building a new property, with a lender that is familiar with the FHA process. Now, we've done a number of FHA transactions, so we're familiar with the process. But I would say give us a call and we can kind of go through it and make sure that FHA doesn't have any red flags on the horizon for your transaction.
And as building the team, as you're looking forward, there's the asterisk that HUD looks for people involved in this, whether it's construction or architecture or ownership, that have HUD experience. And they rely on that HUD experience almost more than we see on the experience for Fannie and Freddie.
Mm-hmm. Absolutely true. So, John, anything more to add on things like this?
Are there certain markets or situations where it makes more sense for builders to go with the HUD route?
I would think in areas that are maybe new developing as opposed to being developed, because they do look so heavy on this market survey of demand. So I think that if there's probably one quick answer, it's try to look in an area that's not totally developed, And you've got a better shot at them not having a saturated lending in that area, or that it would have adversely affect the supply and demand market survey.
Yeah, it's just not the properties in the ground. They're also looking at the lease up timing in the transaction too. So there's other variables that the FHA is looking for in some of these market studies or surveys.
And they will also even look, even though it's an apartment, they'll also look at what single family is around there. What is the demand for people to live in any specific area?
Yeah, the market study, which is about $9,000, is a pretty thorough. It's probably 145 pages, but it's something that they want to see up front when they do a call with you to ask you. They're going to sit down and actually probably bring you in and talk with you exactly what you want to do, and they're going to try to put as many bullets into your argument as possible. So be prepared for that with FHA. Same thing with a conventional lender, but a conventional it's a lot faster, but you just have to go out there and raise more money. And
the HUD people have more people asking questions in that meeting.
Yes, they do. They sit you in the table and they turn on the heat.
Does it feel like Mark Zuckerberg in front of Congress on that?
Almost.
It's very funny. Other crazy, wild things that I've seen on the market right now, people that have not been able to find apartment buildings are again, building their own apartment buildings or converting them over to apartments from, say, motels. So we recently saw a property over in a large metropolitan area in Texas where a group that wanted to convert, say, a 300 unit, a 300 key motel and convert it into Class A apartment building. And so how they were able to do that, they were going to go in and spend $10,000, $11,000, $12,000 a key, a door, into a motel, bring in the little kitchenettes, deck it all out, and they were buying it, say $30-some thousand a room, putting in $10,000 in Class A upgrades to the property, and they felt that they could get $90,000 to $95,000 a room, and they would just be a bunch of efficiencies on the property, and they had a marketplace that was filled with millennials in that area. So they were creating their own apartment complex out of a motel, which I thought was an interesting and dynamic idea. They had done it in other marketplaces. I kind of like that thinking.
I read one also, Paul, that wasn't in this area, but converting a prison.
That you could also say that property was a prison.
And they were all en suite. Each of the units had their own en suite.
So let's kind of go around the table, finish this off. James, anything more to add?
So you just buy it at the right basis, as we always say.
Buy at the right basis. Yeah. John Brixton?
I would say, I think Ricardo makes a good point. For newer investors or investors that don't have experience in a marketplace, I think partnering with the right people is very important, especially on the sponsorship side.
And to follow up on that, John, it's vital to put together a good business plan and acquisition plan, and Old Capital helps many first-time buyers to do that. And there's a couple of things that makes the buyer, really think about the deal and really go right into the upfront due diligence numbers. And number two is it looks good for the lender. It makes you look more professional and you have a better chance of getting across the goal line with the financing.
And listening to everybody's comments, I think that you're most successful if you're in for the long game. And relationships do matter in this business.
Absolutely. I definitely think relationships mean everything.
The only thing I would add is engage us early. We talk about that a lot, but the more time we have to help you mitigate risk, the better.
Sounds good. James, anything else that's going on in the Old Capital world?
I think right now, we finished up with a couple of good speaker series, had 300-400 people at each of our last events in the first quarter. The big event in September 13th, is the Old Capital Multifamily Conference at the AT&T Stadium. So when we talk about relationships and really getting to know not only the listing brokers, the property managers, the lenders, but then also the other people in the room, at this conference, we're really going to try to have you meet as many people, other general partners, other limited partners, and really get to know each other. And so it'll be a little bit different than other conferences that you've been to.
Yeah. So the deal can't get done unless the equity is there. So we'll have a lot of equity people that want to meet you. So if you are a deal sponsor and want to be a deal sponsor, you want to be there for that. If you are the equity and just want to learn a little bit more about where you're putting your money into, is still a good market. Get in the game. Come to Dallas. Come to AT&T Stadium. get on a Southwest jet if you're living up in Salt Lake City or live in Chicago. Come on down to Dallas. See us at the AT&T Stadium. I know that we'll have anywhere from 700 up to 100,000 people at this event. So we had to get a bigger venue. So I'm hoping that 100,000 people show up, James.
We'll try. We'll fit you in. Don't worry about it.
We'll find a good place for you to watch that big screen television that the Cowboys have. Watch the PowerPoint presentation on that. And especially, I want to hear more of the history about our guest keynote speaker, which is
Roger Staubach.
Roger Staubach.
So he's won a couple games in his time and, a couple comebacks as well. So
yeah, we're looking forward to listening to him and his approach on commercial real estate, because if you remember, when he wasn't throwing the ball, he was selling real estate back in the 60s and 70s and sold his company to JLL.
Yeah, back in those days, quarterbacks didn't make as much as they do now.
That's
so
right.
I love that he had to hustle his way through it and started something while he was playing professionally.
That's great. So also remember, go to the Old Capital Podcast, 17-page report on just kind of the structure and downloading of information about doing your own transaction. How do you get it financed? What are some of the rules? If you don't do this on an everyday basis, we wrote kind of a manual, a handbook, 17 pages about how you actually can get it done. Just gives you some general knowledge, basis points, and some general lingo of what you should be knowing and what you should be talking about to potential investors, and also with people looking to sell you an apartment building. So we encourage you to go to the Old Capital Podcast. So I appreciate everybody coming in for us discussing on the beginning of the first quarter, or the second quarter, first week here. So we appreciate your time. Again, James Eng, Dave Walls, John Brixon, Les Meisel, and Ricardo Hinanosa, the best guys in the business. Give us a call if there's any questions concerning financing. We appreciate your time. I'm Paul Peebles.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.